I've made no secret of the fact that I think the market is in a crazy state of euphoria right now, and it's running on borrowed time. There seems to be a bubble everywhere we look. The housing market is now less affordable than it was in 2006 at its absolute peak. US equities were valued higher than they were in March of 2000 at the crazy highs of the dot-com bubble. NFTs are being bought for $100,000 and then sold a week later for $700,000. New crypto projects are popping up left, right and center with no utility, no vision, no future, and yet they're still being valued in the millions of dollars. But maybe you don't want to listen to me. Maybe you want to listen to someone who has a history of accurately predicting market bubbles, and if that's the case, then look no further. Jeremy Grantham, the founder of GMO, an investment fund that has over $110 billion in assets under management. He's an incredibly successful investor in his own right, but he's built his fame by calling out market bubbles, peaks and bottoms, and he does it with incredible accuracy. In the 1980s, he successfully called the Japanese asset price bubble and successfully navigated his way through it. During the dot-com bubble of the early 2000s, he identified the bubble long before most people and led his fund through the following 2 years of turmoil. In 2006, he called the housing and mortgage market bubble, and in 2008, he timed the bottom of the market almost to the day. He's built up a reputation as a man who understands bubbles, greed and euphoria, and is able to predict them with frightening accuracy. Right now, Grantham is warning us of the greatest bubble to ever exist. You heard that right. Not only is Grantham sure that we are in a bubble, but he believes that it is larger than the dot-com bubble, the bubble of 1929, and even the South Seas bubble. Thankfully, Grantham is no hermit. He's no stranger to a camera, and he's more than happy to tell us all what he's thinking to make sure as many people as possible are prepared for what's coming, and that's what you're going to hear today. I'm going to show you exactly what he's saying and why he's saying it. But really quickly, if you're new here, subscribe to the channel. We're putting out loads of videos just like this constantly that you don't want to miss out on.
I think since I said that, we could take out the rivaling 1929 and 2000. I think we've gone way past that. There are examples of large-scale craziness, meme investing, etc., for which there is simply no parallel in 1929 even, or 2000. 2000 had pet.coms, and they were kind of glorious, but they were scores of millions or a few hundred million. We have crazy things now that are billions, and in some cases, tens of billions. And to start at the top with my own favorite, QuantumScape, because we invested 8 years ago when it was 3 years old in our foundation.
And what is QuantumScape?
QuantumScape is a research lab that came public through one of these infamous SPACs quite recently. But wonderful as they are at research, they came public with 4 years still to run before they have $1 of revenue, which is quite remarkable when you think about it. And they came at 10, as always is the case.
Right.
And by December, January, they were 132. And at 132, my investment, which coincidentally was the biggest investment I had ever made, had become hundreds of millions.
Wow.
And at 10, I had made 4 times my money, which is very good indeed in
Yes.
7 years, but not enough to write home to your mother. But at 130, it was 13 times 4, or 52 times my investment, which was the largest ever. And it was bigger than the market cap of GM. It was bigger than the market cap of Panasonic, to talk batteries. And it still had 4 years to run before it had $1 of anything. And the irony, of course, was I'd been sounding off about SPACs as an invention of the devil designed to lure innocent investors onto the rocks. And there I am, having this giant investment in a SPAC. And the second irony was I was holding forth that we would be lucky to reach June the 1st before the bubble broke.
Right.
And we were not allowed to sell until approximately June the 1st because we were locked up. And during that lockup, we watched it go down from 132 to 25.
So, Grantham thinks that we are in the biggest bubble ever and that there are no parallels. And to be perfectly honest, it's actually really easy to see why. In 1929, the bubble that existed was contained to the stock market. In 2000, the bubble was contained to growth stocks. In 2006, the bubble was contained to the housing and the mortgage market. But today, right now, according to Grantham, there are bubbles in 3 of the 4 main asset classes. The housing market is literally less affordable today than it was at the peak of the last bubble. The same can be said for stocks or equities, and Grantham even thinks that bonds are in a bubble. That's without even mentioning things like crypto, NFTs, Rolex watches, or classic cars. Everywhere we look, things are overvalued, and it's never been like this before. Grantham even gave us a perfect example of this: QuantumScape. Now, for those of you who don't know, QuantumScape is a research company that concentrates on battery technology, and last year it went public via SPAC. It listed at $10 a share before soaring as high as $130 within its first 2 months. Grantham, someone who stood to make a fortune, was even stood on the sidelines screaming at people that it was overvalued but unable to sell anything due to a lock-up period. For some context, this would be like Elon Musk shouting at people buying Tesla, telling them that it's overvalued and that it's about to crash. The company didn't even have a plan to start making a profit for the next 4 years, and yet it was still valued at more than General Motors and Panasonic. It was without a doubt a bubble.
I think you've nailed it. The market is a self-correcting mechanism, but it's a little wonky in the time it takes. Sometimes it corrects pretty quickly, and sometimes it corrects incredibly slowly. And that's the problem. But if you go back to 2000, which is the previous leader in speculation, let's say, what happened there is the market peaked in March of 2000. And between March and September, the pet.coms basically went out of business. The internet stocks basically went down 80%, but the whole .com, the whole TMT bubble burst, and the industry, which had been 30% of the market, declined by 50%.
Right.
But the S&P was unchanged.
Yes.
And you could have said during that 5-month, 6-month window, oh, isn't that healthy? They're selling the flakiest pet.coms, and they're buying Coca-Cola. What's not to like about that? And that's exactly what happened. And I like to think of them as the kind of pessimism termites, and they ate through the craziest first, and then the junior growth stocks, and then the intermediate growth stocks, and then finally Cisco, which was for 8 minutes or so the biggest company in the world by market cap. And they were all down collectively 50%. And so for the S&P to be flat in September, it meant that the balance of the market was up 17%. So that looked incredibly healthy, but then the termites reached the broad market, and the entire 70% rolled over and fell 50% in 2 years. And the NASDAQ was down 82%.
Right. So is that the kind of scenario? So you're going to get kind of some rolling corrections, but then eventually you think that in looking at today's market that the underpinnings are so weak that that eventually, you know, it will take down the quote unquote defensive stocks, the high quality blue chip that pay dividends, and that everything will eventually be hit by this bubble of epic proportions.
The thing about the underpinnings is they always look terrific. In 1929, the market didn't peak when they thought the underpinnings were terrible. They peaked when the market's enthusiasm for the underpinnings was approximately the highest it had ever been in history. In 2000, in March, the world uniformly, including the boss of the Federal Reserve, Alan Greenspan, they all thought the system had never been better.
Right.
At the top of the housing bubble in 2007, Bernanke and the boys thought the US housing market had never declined, unquote. It merely reflected a strong US economy. The underpinnings were great. They have never gotten it right. The Federal Reserve in particular has never had a clue about asset bubbles. It doesn't even address it. They act as if they don't exist, except on the upside, they occasionally take credit for the wealth effect helping the economy along. And it does.
Right.
There is an income effect, and it does help the economy along. And Greenspan, Bernanke, and Yellen all took credit explicitly for helping the economy along. What they never did is they never took discredit for the reverse side. The market is mean reverting mechanism, and eventually it goes back to a fair price. And when it went back in 2001, 2002, it had a dreadful negative income effect. When the housing market collapsed and it took the equity market with it, it had a double-pronged negative effect on the economy. So it had a much bigger impact on the economy than had occurred in 2000. And this time, we're really playing with fire, because this time, unlike 2000, we have an overpriced bond market. Jim Grant would argue the most overpriced in 4,000 years.
Right.
We have, in my opinion, and that of many other bubble students, the most overpriced US equity market in history. We have a housing market that 3 weeks ago reached the same multiple of median family income as it did in 2006 at the peak of the housing bubble. And we have commodities that have recently run amok, so that the Goldman Sachs index of non-energy, which is food and metals, which are pretty important, have just equaled the peak of 2011, which was said to be one of those super cycle commodity events. So this is the first time we've ever risked 3.5 asset classes bubbling at the same time. If and when we reach a period of pessimism, the potential unraveling in terms of perceived wealth is much greater this time than it will have ever been before.
So we know that the market is in a bubble. To deny it is to deny the truth. What we don't know is what will happen next, and Grantham admits that. People are trying to think up ways that can allow us to avoid a catastrophic crash, and the ones people keep coming back to is the idea that over the next 10, 12, or even 15 years, the market trades flat and rotations are made within the market away from growth stocks and back into value stocks. Over the course of a dozen years, this would bring valuations down. The market wouldn't continue to fly away into the stratosphere, and there would be no crash. To be perfectly honest, I can see this happening, but Grantham has a great point that we should all consider. He was there during the last bubbles. He called them at the top, and he spoke to thousands of people about the bubbles, just like we are talking now. Time after time, people have made the argument that a crash isn't necessary, that if we just have a calm market, one that slowly rotates away from overpriced assets and towards underpriced ones, that valuations can come back down, and there's no need for some cataclysmic collapse. But no matter how well these people have argued, no matter how many data points and statistics they've gathered, they have been wrong, and there was a crash, because when market sentiment turns, it moves quickly. When asked what we should expect for the future, Grantham pointed out that this last year is looking a lot like the dot-com bubble. A lot of people have got it stuck in their heads that the dot-com bubble was swift and short-lived, but that's just not the case. The growth stocks, the pets.com and other overvalued companies did fall very quickly, but for the first 6 months of the crash, the market as a whole traded sideways as value options increased in value and people rotated away from the hype. But once that rotation had occurred, once valuations on the Nasdaq had fallen by 80%, the rest of the market followed. It took 2 years from the peak of the bubble to the market bottom, and there's a good chance that that's the same thing that's happening right now. Grantham also made it clear that the Fed don't have a clue what's going on, and they never have. They like to claim credit when the markets soar, but they rarely, if ever, comment on a bubble once it has popped. Whether it's Greenspan, Bernanke or Yellen, the story is always the same. Grantham is telling us not to trust the Fed, and I can't echo that sentiment strongly enough. Ultimately here, Grantham's position can be summarized very nicely. The bigger the bubble, the bigger the decline, and we are currently in the greatest bubble in modern history. Grantham did go on to explain how he is investing during these turbulent times, and it's something that I do plan on covering sometime next week, but I'm afraid we're out of time here today. If you're new to the channel and you enjoyed this video, then make sure to subscribe. If you want to help spread the word, then consider liking the video and leaving a comment, and YouTube will do its part by pushing this video out to more people. I really do appreciate all the support you give the channel, even if it's just leaving a like. If you want to help out further, there is a link down below in the description to BlockFi where you can get up to $250 in free Bitcoin, and you can earn interest on whatever crypto you hold, whether it's Bitcoin, Ether, or even stable coins. You can earn as much as 14% interest a year. There's also a link to my favorite brokerage called eToro where you can trade stocks, shares, crypto, commodities, foreign currencies, and more, all for 0% commission. So make sure to check that out as well. Thanks for watching. Until next time. Hey guys, so really quickly, I recorded this video before all this stuff about my channel getting deleted came up, so I'm just going to give you all a quick update. I'm still not sure what's actually going to happen regarding the channel, but I have set up a second channel called Stoic Finance 2, where I'm going to be uploading my older videos to try and get that channel up and running again in case this one does get deleted. So make sure you go and subscribe to that channel and follow me on Twitter as well, so you can find me again no matter what happens. Links for both those will be down below in the comments and the description. I'm working on setting up my own website as well, where my videos will be posted in the future. And I'm looking into setting something like a Patreon up as well. In general, I'm just trying to diversify, because even if this does all work out, it's reminded me how channels like this that are only on YouTube are just at the absolute mercy of Google. And I don't want to have to censor myself and damage my content in the future because of that. Thanks for all the support, guys. It's been huge. Hopefully it's all alright.